The Nifty has plunged 10% from its record highs, officially entering correction territory. With bears in full control, the index has hit a 4-month intraday low, signaling potential challenges ahead. Investors should tread cautiously, as experts advise close monitoring of key support levels and market sentiment. Several key reasons are driving the current market sell-off. First, a major contributor is the aggressive sell-off by foreign institutional investors, FIIs, who have pulled out a record 1.2 lakh rupees crore from Indian equities since October. This exodus is driven by rising US bond yields, which have hit 4.42%, and a stronger dollar index. The higher yields are making US investments more attractive, putting continuous pressure on Indian markets. Additionally, weak corporate earnings have further hurt market sentiment. Disappointing second-quarter results from leading companies have created uncertainty among investors, worsening the market's downward trend. Together, these factors are generating significant headwinds, and caution is advised as volatility remains high. Technical concerns are a critical factor behind the current market pressure. The Nifty is hovering near its 200-day moving average, signaling an oversold condition. Analysts highlight a potential support level at 23,500 but warn of resistance at 24,500, which could limit any rebound. Furthermore, mid-cap and small-cap indices remain exposed to further losses, even in the case of a relief rally. Adding to the stress is rising retail inflation, which has surged to 6.21% in October, a 14-month high. This spike reduces the chances of a near-term rate cut, putting pressure on the Reserve Bank of India, RBI, to revisit its strategies to contain inflation, further impacting market sentiment. The stock market's recent correction has sparked anxiety among investors, but it's crucial to remember this isn't the first time we've witnessed a steep decline. Historically, the market has gone through several corrections, with falls exceeding 10%, and yet, over time, it has shown remarkable resilience and growth. Let's dive into some notable instances to better understand the nature of market fluctuations. First up, we have the dot-com bubble, where the Sensex saw a massive 53% drop in the early 2000s. This was a time of widespread speculation in tech stocks, and the subsequent burst of the bubble led to substantial market losses. Next came the Lehman Brothers crisis in 2008, which marked the global financial meltdown. The Sensex plummeted by 61%, reflecting the impact of the subprime mortgage crisis and the collapse of major financial institutions. Investors around the world were gripped by fear. In 2013, India was labeled as one of the fragile 5 economies, leading to another sharp decline. This time, the Sensex corrected by 31%. The term referred to economies that were overly dependent on foreign capital, causing investors to pull back amidst fears of a slowing global economy. The demonetization shock in 2016 resulted in a 22% dip in the market. The surprise government announcement invalidated 86% of the cash in circulation, aiming to curb black money but causing a short-term panic in the markets. Then, in early 2020, the COVID-19 crisis triggered a market crash as the pandemic spread rapidly across the globe. The Sensex tumbled 37%, with economies locking down and global supply chains getting disrupted. The Russia-Ukraine war in 2022 was another major shock, leading to a 10% market fall as geopolitical tensions escalated and commodity prices surged, impacting global economic stability. Most recently, we've seen a 10% correction driven by poor quarterly earnings reports, reminding investors once again of the inherent volatility in equity markets. Now, let's explore the difference in returns if you invest during a market fall versus buying during a peak. Take the demonetization correction as an example. If you invested during the peak, your returns would have only grown by 41% over a given period. However, investing at the lowest point during the correction would have yielded a whopping 81% return. This underscores a powerful investing principle. Downturns often present unique buying opportunities for those willing to stay the course and remain disciplined. It's vital to grasp that the stock market is not linear. Volatility and fluctuations are an inherent part of equity investing. Market corrections, although unsettling, are entirely natural. In fact, they serve as healthy resets, allowing overvalued assets to align with their fundamental values. Recognizing this cyclical nature is crucial for any long-term investor. Before investing in the market, it's essential to understand how to mitigate risk while capitalizing on opportunities. Diversification is a key strategy. Spreading investments across different sectors and asset classes can reduce exposure to any single market event. Additionally, maintaining a long-term perspective helps you avoid emotional decision-making during market swings. Consider using systematic investment plans, SIPs, to invest regularly, rather than trying to time the market. This approach allows you to buy more units when prices are low, averaging out the cost and reducing the impact of market volatility. Building an emergency fund can also ensure that you don't have to sell investments during a downturn, giving you the confidence to stay invested. Remember, market corrections can be unsettling, but they can also create excellent opportunities for wealth creation. Staying informed, being disciplined, and understanding market cycles are critical steps toward long-term success. So, the next time the market drops, don't panic, take a moment to recognize the opportunity it might present. The share market is an ever-evolving landscape, and its fluctuations are a part of its very nature. By understanding these dynamics and being prepared, you can turn market volatility to your advantage. As always, think long-term, invest wisely, and stay resilient.